Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, time to look at the SPY, which is our proxy for the S&P 500, the PCC and the VIX. Sorry it's been a while again, but this is the first opportunity I've had to sit down and record something for YouTube. I'm still getting my weekly live streams out for my patrons, but YouTube is just something I can only do when I've got the time. So I figured we'd look at the US market. Essentially, quick synopsis of what I'm going to tell you this video. Our bullish count, which is our primary count and has been for many months, I still believe is the correct one. It's business as usual. Market continues to go higher, having priced in what it believes to now be peak rates, anticipating the decline of those rates into the future, further expansion of liquidity for stocks. However, the caveat to this video is we are overbought, we are overdone, we are overextended, we're getting a little too cocky, and some period of consolidation in both time and price should be expected soon. And that's really all we've got to go on. Okay, so let's have a quick zoom out and do some classical analysis before we dig into the count. One thing I just want to point out, if there's a video on my YouTube channel which was the 2nd of February where I said cautiously bullish, and we spoke about the extreme readings in the PCC and the VIX that we'd witnessed, and that I felt that that was peak fear for the cycle and we would not make another low. Now that's turned out to be absolutely true, and I've been validated with that opinion, which is nice. But it was a little touch and go for a while as we had certain pivots and levels we wanted to break, but we assigned primary to the bullish count at that moment and we stuck with it. And it has most likely turned out to be true. So I just want to walk back through time and just talk about the absolute basics we're looking for here in the technicals, and where I think it's often the case that bears specifically go wrong with anticipating collapses and crashes and further lows. We're going to use our really basic 60 exponential moving average and 250 exponential moving average here, the orange and green lines. And then we're going to use our extremes in the VIX readings and the PCC readings to signal these lows. Then we're going to look at the divergence on the larger time frame, the weekly time frame, between our relative strength and momentum indicators and price action. So what we saw from the peak was the first swing low and high to our lower high. From that point we're going to get a crossover of the 60 through the 250, and we're now into a bearish phase. At this point we are looking for extreme oversold readings on the larger time frame, and then we are looking for divergence to build up to the upside, and then we are looking for peak fear to occur, peak volatility and peak fear to occur at that point. So let's come out to the weekly time frame. We see a retracement to the 250 exponential moving average on October, which was the low. We came back to the 250. We look at our RSI readings. We get divergence between the June 22nd low here and the October low, June 22 and October 22. Bullish divergence. We came from overbought to oversold on the weekly time frame. We get an extreme reading on the PCC, okay, and then we get bullish divergence between those two lows, while the market makes lower lows in price, higher lows in RSI. We then get another PCC extreme reading here, the most extreme we've seen for many years. That was a moment where I said that I felt this low was going to hold. This was a sustainable low, which meant that this was the market low. And this is the first move off of it. Now, any Elliottician will tell you the easiest pattern in the world to trade is a zigzag, because everything zigzags. 535, whether it's A, 535, whether it's B in a flat, 535, whether it's part of a larger zigzag, 535, whether it's 1, 2, 3 of an impulse, blah blah blah, 535, right? Motive, corrective, motive. So whenever we see a swing off of the low and a pullback, we've got an 80% probability that we're going to go to another high. Okay, that's exactly what we did here. It was only a marginal higher. However, combined with the bullish divergence, combined with the dying off of bearish momentum, combined with the extreme readings in the PCC and the long-term retracement to the 250, I assumed that that low in December was going to hold, and we would continue a bullish sequence of higher highs and higher lows, and that's exactly what we've done. Now if we just go back and look at prior examples of this, so let's take the COVID panic. Right, so we get this was we didn't have time to think, guys. Here, if you were in this, it was amazing, and I don't mean that in a good way. What kind of, because it's still amazing to just be there and witness it. 60 crosses through the 250. We're down and bottomed with our extreme VIX reading, extreme PCCV reading on huge volume at the lows in no time at all. Right. That's our bearish correction. Once that 60 crosses through the 250 after receiving that extreme reading, it trends higher, 60 above the 250, 60 above the 250, until we reach the peak here. 60 through the 250, bearish until we cross higher like we have again. If we go back prior to that, to the 2018 Powell pivot, the last time we tried to raise rates in this cycle, we went 60 through the 250, got our extreme PCC reading here, and then we moved higher. 60 through the 250, bullish phase. Right, the one prior to that was the 2018 sell-off, not a big one, only came back to the 250, didn't get a crossover. Trump's election into 2016, 60 through 250, extreme PC readings and VIX readings on the prior lows, made subsequent lower low, offered bullish divergence on the weekly time frame, 60 through the 250, extended rally. Prior to that, we had to go back to the fear of a double dip recession. In 2011, off of the back of the GFC, we got PCC and VIX reading extremes down here, 60 through the 250 bearish, 60 through 250 bullish, maintained subsequent zigzag higher, swing low 535, and then continued the bullish trend up. Prior to that, it was the collapse of the GFC, 60 through 250 bearish reading, and then back above. So this is just the way things tend to work. Now, you got to be careful when talking about the macro, because the macro bears, excuse me, would have told you since the 2000 crash and subsequent GFC crash that there was no reason to move to new highs. The economy was broken, it was never coming back. Now, that's not the case. It went off like a rocket. COVID, we heard similar things, that this was the end, we're going to fall and we're going to collapse forever, and it didn't. It went off like a rocket. The market does not care. Does not care at all. We're in a situation where we're now pricing in peak rates. We're getting anticipation for rates coming back down. Okay? Inflation has come down faster than it went up. I said this before Christmas last year, that inflation was going to fucking plummet, that we tightened too fast, and CPI was going to implode, and that's exactly what's happened. Okay? So I still feel my long-term thesis, which I've gone over multiple times with my patrons, is the correct one, which is we are in a bullwhip effect of we have inflation as a result of fiscal stimulus and monetary stimulus. Monetary stimulus tends to be isolated to financial markets. For 14 years it did not leak into the real economy. We had inflation down at 2%. Fiscal stimulus does leak into the real market. We saw the result subsequent after the supply chain shock of COVID combined with this massive stimulus. We saw inflation reach 9% in the United States. Rates came up way too fast, way too aggressively to try and stifle that. Inflation has collapsed. When it collapses to the point where deflation becomes the fear, we will get a larger wave of degree correction, another big crash. Off of the back of that, the Fed will cut rates and will go back to quantitative easing, and the printer will start up and trillions will start flowing again. Fiscal side, I don't know. I haven't got a clue. I'm not the President of the United States. I don't know, but I would bet that if things get rough enough, there will be fiscal stimulus again. And if we have monetary stimulus on a huge level, cutting rates back to zero, maybe even negative, and fiscal stimulus behind it as well, and all the supply chains have come back on fully, well not fully, but are running at way better efficiency than they were circa 2020-21, we will be in another massive expansion inflationary cycle. That inflation won't arrive overnight, because everyone thinks it will. It won't arrive over the months, or maybe even the quarters. It will arrive a year or two, maybe even longer afterwards. At that point, it won't be 9% inflation, it will be 19 or 29%, and that will be the next big inflationary cycle. And this bullwhip effect of overreact at the top with too high rates too quickly, push the economy into recession, overreact at the bottom with too much printing, too much rate cutting, too much quantitative policy, overreact at the bottom, and so on and so forth. And we'll just keep doing that. Okay, terrible for the average person, terrible for the average person's earnings and wages, terrible for the real economy, fucking awesome for us traders. Okay, literally cannot get a better environment than that. So we should just be thankful that the world's run by a bunch of lunatics. I wish it wasn't, and I'm not being arrogant and saying, oh great that the world's burning. Look, you make hay while the sun shines, and you live in the reality that is. And the reality that is the financial markets don't give a shit. Okay, so now that we've covered the classical analysis, let's just bring up our moving averages, our indicators again for the short term here, just to point out the weakness that's occurring on the day time frame currently. So we have divergence between prior high and current high. We can't call it a confirmed high because we're trading higher in the pre-market. We don't know how much higher we're going to go, but for the moment there is divergence between the prior high and the current price in the momentum. We've also got the same story here in the RSI, so we are getting weaker into this high. We're getting weaker. So if we now bring up our Elliott wave count, bring down the 4 hour here, turn off the moving averages, bring up our Elliott wave count, a series of overlapping 3s into 4s is what we should be expecting now. I'm not saying it's going to happen today or tomorrow or next week, but it's coming. That's what I think is occurring, and that's what I think is going to happen next. So we've gone through one wave 3 target at minute degree already, 1618 extension here at 451.10. This is off of this pivot. When we've got this pivot 12 at minor degree. Here's the 1618 extension of this 474.91. This if we reach this target will put us just off the highs. Just about 1% off of the highs. We're currently only about pre-market price less than 5% off of the all-time highs at the moment, so we're very close to the all-time highs. I believe they're going to break. I believe we're going to go way higher in the long term, but this is likely what I think is going to occur. So if we've gone 1 2 1 2, here's the 3 of the 3 at minute degree. Sometime sooner or later that 3 is going to come in. The 4 is going to come back and not invalidate the wave 1 here at 418.31 because that's not allowed. And then we have the next completion of the 5 of that minor 3, and then that minor 4 will come back into 4 territory and then move back up again into the fifth, on its way into the 5th at minor degree. So what we end up with, guys, is a overlappy sideways period of consolidation underneath, above, around the all-time high. Maybe above it, maybe below it, I don't know, but it will be a period of extended sideways action. Alright, and it will be a bit tiresome to deal with, and it will be a bit testing, but it makes sense as we go 3 4 3 4 5 that we're coming into that period of rates having peaked, concern about actual recession coming, deflation concerns, the market wrestling with the idea of the threat of a real recession combined with the relief of lower rates, what that means for equities. It means consolidation, it means uncertainty. Longer term, however, it means party time. Right? Now when the actual problem comes, and it's only a problem for those who are buying the top again when it arrives, not a problem for us, it'll be an excellent opportunity for us, is when this larger wave 3 completes and consolidates into 4, we will get a 5th complete at some point. I don't know when, but it will. That will be another wave 1, and then we get this. We get another one of these big ones. Another big correction, right? Another big crash. That will be the next big opportunity. I can't see the future, I'm not psychic, but my assumption would be that would come off of the back of an actual recessionary fear, actual deflation, actual economic problems, and then we will have that bullwhip effect that I was talking about, the cutting of rates, the expansion of QE, money printing, perhaps even fiscal support, UBI, who the fuck knows, right? Whatever it is, it will come in the trillions, and it will find its way straight here into the financial markets, into the US stock market, and it will be party time for us traders again. Alright, so that's what I think is going to happen long term. Currently I have the chart in a 1 2 1 2 1 2 minuet degree, 3 4 minuet degree, now marching up in a 5th wave at minuet degree, looking for that 3rd off of the back of that daily divergence before we break down. That's the way I see the count. From a bullish, that's the bullish count, that's the primary. I can't really find a bearish one, to be absolutely honest with you, but if I had to force one, now that we're so close to the highs, hang on, it would be a flat. I would say, in fact, I would delete that X wave now because that's now less likely. We've gone through the 61.8% retracement. We've now gone through the 78.6% retracement. We've now gone through horizontal resistance, and we've gone through the one-to-one relationship of what should have been a zigzag. Even if we count that as a running flat, okay, and we go 1 to 1, we've gone past it. That was the perfect point for this to have been a motive structure, this to be corrective, and this to be another motive structure. The only motive structure that you could think of here was an expanding diagonal, okay, but I disallowed it because the fifth wave's not long enough. 1, 2, 3, 4, 5. 5 should be longer than the 3 isn't, okay, so I don't like it. So I've always seen it as corrective, but if you are holding on to that, the cutoff point is going back above to the all-time highs. We cannot lead with 5 and go above the all-time high. It's just not possible. There's nothing in Elliott wave which allows it. So if you make the all-time highs, you can't have a motive structure here, can't have WXY, can't have ABC as a zigzag. So what you're left with is a flat. You see this as corrective, we see this as corrective, we see this as impulsive. That's the only option left I see. I consider it less than 20% odds of occurring now, just because we continue to push all these higher pivots and push for all these larger extensions and basically shrink the wave degree down. So pivot, pivot, this is all small itty bitty price action. All of this screams wave 3 to me. Okay, we've got the RSI readings, we've got the accumulative volume, we've got the high readings in the RSI, high readings in the MACD. It all feels right. Okay, now if it isn't, and it is A, B, C, then it could be A, B, C expansive B. It could be A, B, C back to 90%, and then a correction down. I'm not going to write it off completely, ever. I'm just saying it's pretty low odds right now. If things collapse, then we can reconsider. Now the thing we'd be looking for that collapse to occur would be if we invalidate the primary count first. So 1, 2, 1, 2, or an alternative is that this is 1 into 2. Either way, we can't come back beyond this wave 1 of 418 spot 31. Come back beyond that, wave 4's invalidated the wave 1, so that counts wrong. At which point the alternative bullish count has an invalidation point a little bit lower because of an expanding flat pattern. We'll add that in here. 410 on the dot. Okay, and that becomes an invalidation point for the alternate count. So we've got a long way back. This is the idea that this was a running flat into wave 2 and we're now into wave 3. Invalidations here at 410. That's my backup bullish count. My primary bullish count is this one, which is this is 1, 2, 1, 2, and this is the invalidation point for the minute degree at 418 spot 31. If either of those break, then a bearish count of an expansive B wave or a B wave coming back at least 90% and a 5 wave move down into a flat seems to be the most probable possibility to me as a bearish count, but the primary is bullish. So that's how I see the Elliott wave count. If we come over to the PCC, we can now see these are the readings I recorded on the 28th of December 2022. Extreme candle reading of 2.123, line chart reading of 1 spot 947. This was peak fear. We came back with the 60 through the 250 and are now heading back towards extreme complacency and bullishness. Will we make new lows like we did back here? Maybe. Will we come down in one go? Probably not. We tend to meander. Right, we tend to meander our way down. We will probably do something similar here. But that's where we're heading. Longer term, that's where we're heading. We've peaked. We've had our peak fear for the cycle. Peak fear, back to bullishness. Peak fear, back to bullishness. Peak fear, back to bullishness-ish. Peak fear, and back to bullishness. Peak fear, and back to bullishness. Alright, so that's what we're doing now. I'm not psychic, like I said. I have to speak positively because I have to have conviction in what I'm saying, but that's what I think is happening. But it won't be without hiccups, as we've seen. It won't be without hiccups along the way. We will have moments of fear again. But I think the extreme peak was reached here, and that confirmed the low we were talking about before we would swing high, and that's what we've done. So, expecting some kind of pullback in the PCC, some kind of spike in fear, at least temporarily, in bearish bets, at least temporarily, while we consolidate sideways in the SPY. It hasn't started yet, but it could start any day now. The VIX. Right, long-term support for the VIX has broken, going back to 2017. Here's these lows. Here's the trend higher. And now we've broken it, back tested it and fallen lower. Long-term horizontal support is all the way back at 8.73, which is the lowest the VIX has ever gotten to. Now, just because it's the lowest the VIX has ever gotten to does not mean we can't go lower. Right, we mustn't assume there's a floor, a god floor, which stops anything from ever going lower. We don't know what the future holds, but for the moment we're trending downwards. Okay, and we've broken that long-term upward trend that we've been in since 2017. Now, if we look at the prior extreme readings in the VIX, we've dotted them all here with our little blue boxes. We've recorded those on the chart. And we've also got our big ones, which is the 96.4 reading of the GFC, Global Financial Crisis, and the 85.47 of COVID. Next, we have what I call a panic line, which is every extreme which isn't a global event, which is around the 48.50 mark. We're way off of it. We're in a downward trend of lower lows and lower highs. If that reverses, right, that's likely consolidation time for the markets. But we've got no sign at all of an absolute explosion, of an impending explosion, right? In a correction possibly, okay, and that's what I expect is going to continue. So to sum up, we're bullish, we have been for months, we're continuing to march higher, but we are getting a little overcooked, we're getting bearish divergence building up, we're overdoing it a little bit, a period of consolidation should be expected, and then pressing on higher over the longer term. If, for whatever reason, we break down violently and we transgress into the 418.31 of this invalidation level and the prior wave 1 lower, then we are bearish and we need to consider our bearish options. And as always, when we're approaching a high, just like when we're approaching a low, we get that first impulsive move up and that first impulsive move down, that's our opportunity to short and take some profit off the table and protect ourselves. The issue, and it's not really an issue unless you let it be one, is the desire to rub it in the face of the opposition, and I'm guilty of it because I'm human. Everyone else is. I don't want to do it, but it's just part and parcel of having to counter arguments, is the assumption that someone who gets caught up here is fucked. That's not the case at all. And someone who gets caught here is fucked. That's not the case at all. If you know what you're doing and you're taking sensible risks and managing risks, then you know that if you've been bullish this whole time, 5 down and 3 back to a lower high off of a high is an opportunity to short, take profit and cover. Because yes, it could be a correction, in which case you look for 5 up and 3 back after a 3-wave move to get bullish again. Right? If we continue down, that's 1, 2 into 3, we're now short, we're now protecting ourselves, we're now waiting for a larger low to come in. So yes, it's good to be bullish off of a low, and yes, it's good to have conviction of a long-term count. But you should always be flexible on the short term. Always be prepared to change direction with the wind. Okay? Okay, so we'll leave it there, guys. Thank you very much for joining me on this technical analysis of the SPY, the PCC and the VIX. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you're interested in unlocking the Elliott Wave series and learning how to do this kind of analysis to yourself, plus weekly live streams, plus a bunch of other benefits such as access to the public Discord, then you can consider joining the Patreon. The link's in the description box below. Take care of yourselves, and I'll be back with you as soon as possible. All the best. Bye.